Last evening, John Taylor quoted George Shultz, Secretary Shultz, saying that governments should set the rules and then let the markets work. So I'm going to state the obvious. Markets can't operate without rules, just like sporting events or driving on the roads or building buildings can't be without rules, and rules constrain somebody. So also I should note the obvious, that Secretary Shultz obviously knew that enforcement of rules is part of the issue, and that rules are useless without enforcement. So when we talk about rules and how they work, how well they work, we have to talk about how they're designed and how they're enforced. And that is the topic of this session. Now, there are many governments in the world, again, taking the word government here as opposed to the word rule. When a government sets a rule, like a US federal government, oftentimes it's done through the legislature, there are different words associated with it, is what I'm saying, called, a law, an act, a statute. And then you have the dreaded word regulations, which all of the difference really is who writes the details of it, whether it's an agency of the government or the legislature signed by the president. So the difference between laws, acts, statutes, and regulations is only technical. All are rules, and all need to be enforced by somebody. So that's just the basics. In the case of banking, so the enforcers in banking are always start with Department of Justice if there was any crime, and all sorts of regulatory agencies, some of which do the enforcement, some of them do not, in the form of supervision, examinations, all of that. So then the enforcement, of course, involves what is allowed to do, if a rule is broken, what happens, how you deter the breaking of the rules, etc. And so often the devil is in the details, and therefore a lot of lawyers are always involved when rules are written and enforced, and there are always kind of the courts hovering around this. So this policy conference is about central banks, and a lot of what we talk about is monetary economics here, so it's very rare that we have a discussion of regulations, but the rules actually matters to central banks, and central banks actually play a big role. First of all, central banks need the private sector banks in order to transmit their policies. And secondly, so they need a stable banking system. And secondly, they're often involved themselves in the regulation, in writing the rules, in enforcing the rules. In the US, it's kind of a whole mess about who does what. But anyway, so in addition to this, by the way, and importantly, central banks are serving as lenders of last resort, so they actually play a role in private markets as buying assets, as lending to private sector institutions, and that role has expanded in the last 15 years, let's say. Certainly in the financial crisis, certainly in COVID, we already heard some of that, and again in the recent situation that evolved or came into the open in March, which is why we're here. Okay, so current events to set the stage for this panel. We had 3 banks that were sizable enough to really deserve a lot of news coverage fail in the US, all over $100 billion, 2 of them over $200 billion, 2 of them in this area. So it was Silicon Valley Bank, it was Signature Bank on the same weekend in mid-March, and it was then more recently First Republic Bank right here. Meanwhile, in Switzerland, and we don't have Swiss people here, but this was a major event, Credit Suisse, one of the 30, now 29 global systemic financial institutions, was sort of forced into marriage with another SIFI, global SIFI called UBS, creating a monster SIFI in Switzerland, twice the GDP. So what happened there is another issue, and because one of our panelists was the chair of the Financial Stability Board, and there are other international bodies involved in the regulation, like Basel Committee for Bank Supervision, et cetera, it's important to talk about the global banks as well as the local banks in every jurisdiction. In the US, on this issue, one of our biggest SIFI, JP Morgan Chase, already violating the law about having more than 10% of deposits in the US, as is Bank of America, by the way, bought First Republic Bank recently from the FDIC, or with the FDIC controlling the process mostly. So this is kind of the background. I will just mention 3 points of fact that I hope come out in the discussion by our panelists, or come out in the questions afterwards, or maybe I'll interject since I have the mic and ask. First of all, the supervision and enforcement of the rules. So the banks that were failed in the US were supervised by different agencies. SVB was supervised by the Federal Reserve as a bank holding company. Signature and First Republic were supervised by the FDIC. And there were state regulators, but they weren't that involved. All of these 3 banks received high CAMEL ratings, namely the ratings that the supervisors give, including about this thing called capital, a piece of the regulation that I know well about. So they were well capitalized, as was claimed by FINMA about Credit Suisse right before they failed. So the question arises, how can we have well-capitalized institutions fail within a very short amount of time, and whether we should rethink the definition of well-capitalized, of what it means to be well-capitalized, in particular, and relevant to the 3 US banks, or at least to 2 of the 3 US banks, the risk that they took that ended up leading to their demise was interest rate risk, which is, of course, relevant for monetary policy conference. And on the other hand, the capital rules tend to ignore interest rate risk. So risk weights only take into account credit risk, not interest rate risk. And the stress test, of course, there was another question about how much they took scenarios into account and how much they use accounting rules, which do not recognize losses on held-to-maturity assets. We're going to hear more about this later. But I just raised the question of what it means to be well-capitalized and how a well-capitalized bank can default or go into insolvency very shortly after being well-capitalized, and whether it would be useful to have the definition of well-capitalized in the rules such that violating it does not mean you're at insolvency, basically, that there is time to intervene before insolvency for prompt corrective action, which is a principle of the regulation. And whether we should also have market-based stress tests, which involve, for example, the market stress test, what I call raise equity. Okay, second, in 2014, Mark Carney, as the head of Financial Stability Board, before Mr. Qual took the job, declared with other nations and other regulators that we no longer have too big to fail problem, or that we so took care of it through the use of loss-absorbing debt called TLAC. And the TLAC will be absorbing losses in resolution for non-viable banks. Yet, in Switzerland, the Swiss were among those cheering for TLACs all the time. The authorities chose not to go to resolution and not to impose losses on 50 billion Swiss francs of TLAC securities. They did wipe out some AT1, alternative tier 1 equity, capital. We have to wonder, therefore, what happened to those promises that the TLACs will be there for failed banks. And on this topic, one last thing, has to do with cross-border resolution. One of the reasons that the Swiss authorities did not trigger is that the Financial Stability Board report key attributes to cross-border resolution has a huge wish list that is simply not going to happen. It involves collaborations across countries and trusting other countries for single point of entry and other issues when global banks operate and are systemic in multiple jurisdictions like Credit Suisse was and JP Morgan definitely is. So we have to confront the question of whether it is okay in a market economy to have institutions that cannot fail. So I just bring that up, and I will then turn to Darrell Duffie first, and then Randall Quarrel, and then Amit Zero. Thank you very much.
Thanks very much, Anat. And thanks for the opportunity to speak to you about this. I want to return for just a second to the previous panel and add my congratulations to the 30th anniversary of the Taylor Rule. Now, as Anat has amplified, we've learned a lot of lessons just in the last couple of months about some weaknesses in the regulation and supervision of banks. And I mean, it pretty much covers the gamut, and it's quite disappointing. It goes to resolution, it goes to capital, and in the capital area, stress testing, disclosure, proper accounting, just the entire capital regime. And let's just stipulate, as Anat has, that this was a solvency concern. However, I want to focus on what has been revealed by recent events about weaknesses in liquidity regulation. This is not to suggest that liquidity was the cause of failure of these banks. It was capital. However, as shown in this chart that came out this week from the Federal Reserve's Financial Stability Report, we've learned that depositors at large banks can leave now much more quickly than they have left in prior bank runs. So you'll see on the chart, among the largest bank failures of the last decades, what fraction of deposits left in a single day. And you can see in the case of Signature Bank and Silicon Valley Bank that more left in a single day than regulations anticipated would leave in a month. I'm going to come back to that in a moment. So I'm going to talk about what has changed with respect to the speed with which uninsured or large depositors can leave, and what the Federal Reserve System can do about it in the next few minutes. So I'm going to give you a hypothetical bank. This is not intended to represent any particular bank that has a large amount of wholesale deposits, essentially all uninsured, has also some insured deposits and other liabilities. This bank is meeting current liquidity regulations. Why? Well, because in current regulations, it's assumed that even over a 30-day period, let alone the 1 day that I showed you a moment ago, either 25% or 40% of these wholesale operational deposits are at risk of fleeing the bank. And if you only need to cover 25 or 40%, then you don't need very much liquidity coverage under current regulation. So this bank is perfectly fine under current standards. But we know it's not perfectly fine in practice because I just showed you a moment ago that not 25% in 30 days, but rather 40 or 60% of wholesale deposits could leave in a single day. So something has to be fixed if, for the case of a solvent but weakened bank, liquidity is going to be adequate to prevent the diamond Dipvig sort of run that we did not experience this time because it was a solvency crisis, but we could experience the next time that we get into this situation. So what has changed? Well, this is a slide from Jason Goldberg at Barclays last week that shows that over the last decade or so, technology for depositors has changed. You'll see, for example, a huge increase in the amount of online banking and proportionately a much larger increase in mobile banking, so taking just for 3 banks the number of customers using mobile banking from about 20 million to about 120 million over the last 11 or 12 years. That's quite remarkable. And it now means that, aided by other technology like social media, Twitter, and email, whatever technology by which large wholesale depositors are connected to each other and to the news, giving them the ability to move their money essentially instantly, which is exactly what we saw. People are not lining up at the banks like they were in the classic bank runs. So let's suppose that we use the current approach to covering liquidity, but get much more realistic about how much liquidity needs to be provided by a bank to cover the wholesale, large, uninsured depositors. Well, if you follow the same principles and you assume, as I would, that a large depositor would leave essentially instantly, then you need roughly 100% coverage of the wholesale uninsured depositors. Now, some of you might find that shocking. How could you go from 25% to 100%? Well, I mean, there are some people here from the private sector. If you were to learn today that a bank in which you are keeping your uninsured deposits was at risk, what fraction of your deposits would you leave there? And how many of you might be left out of the news of that event? Well, I think the answer is pretty clear. I mean, it would be clear to me that I would simply instantly move my deposits. So a realistic number would be close to 100%. Now, those of you that are pragmatists in the audience would say, well, that's ridiculous, because then the amount of high-quality liquid assets that would be necessary to back those deposits would be very, very onerous. It would trap in the banking system an enormous quantity of high-quality liquid assets, which for most of the time are completely idle and unuseful. An example of that occurred in September 2019, where even under the old, quote-unquote, easy liquidity requirements, large banks were unwilling to let go of their Federal Reserve deposits to quell a real problem in wholesale funding markets. And overnight interest rates in wholesale funding markets went to 1,000 basis points intraday when risk-free rates were zero or near zero. Jamie Dimon, in his earnings call immediately following that September 2019 crisis in repurchase markets, was asked by an analyst, you had a lot of reserves. Why didn't you invest them in order to earn these enormous interest rates and arbitrage that repurchase agreement crisis back to normalcy? And Jamie Dimon referred specifically to liquidity requirements in regulation that say that they must be able to cover all of their intraday needs for liquidity, intraday, not just 30-day, intraday needs for liquidity, with their own resources. And the most popular resource that a bank has today are Federal Reserve deposits. So if you imagine the quantity of Federal Reserve deposits that are now trapped already by regulation, and then you look at this chart and follow my suggestion that virtually 100% of the $7 trillion of uninsured deposits in the US banking system would have to be 100% covered by high-quality liquid assets. It's not realistic, at least not realistic, unless the Fed increases the size of its balance sheet even further. So what's the proposal? Well, of course, it includes my proposal to increase liquidity coverage, but at the same time, to make a much more realistic and useful approach to how banks are assumed to get liquidity from the very foundation of the Federal Reserve System. The purpose of central banks, the primary purpose of central banks, is to provide liquidity to the banks themselves, so that in a time that, like that we have seen in the last 2 months, banks are able to appeal to the Federal Reserve by posting their assets at the Fed's discount window in order to receive the liquidity that they need. Let me repeat, under current regulations, that doesn't count. Banks currently must be self-reliant must be assumed to be self-reliant in order to meet their liquidity requirements. That's a mistake. And it's been recognized by many. I had an exchange this morning with Bill Nelson in which he pointed out that Mervyn King, in his speech, Pawnbroker of Last Resort, pointed out that access to the discount window should count towards liquidity requirements. That idea has been picked up by a number of others, including Bill himself, including my co-panelist Randy Quarles in a speech that he gave some years ago, and in some countries has been attempted, but not in the United States. And maybe in the Q&A we can get into some of the discussion about why this isn't working in the United States, but it needs to work if going forward we're going to have a situation in which banks can both cover the liquidity needs imposed by their depositors and at the same time not tie down so many high-quality liquid assets that those liquid assets are not available when they're needed. The Financial Stability Board put out 2 reports in the last 18 months, which are basically congratulating the quality of banking regulation improvements since the financial crisis. On many fronts, however, in a quiet part of one of those reports, it discusses problems associated with usability of high-quality liquid assets. Again, it's the famous last taxi at the taxi stand. I'm sure that almost everybody in the audience is aware of this anecdote, but the story goes, a weary traveler arrives at the train station and is looking for a taxi. In this case, a taxi, the analogy is with high-quality liquid assets. Arrives at the taxi stand, and thank goodness there's only one there is a taxi at the taxi stand, only one, and the passenger requests a lift home, and the taxi driver says, no, we're required by regulation to ensure that there are always at least one taxi left at the taxi stand. And the passenger says, well, I'm here. And the taxi driver says, no, rules are rules. So in this analogy, you can see that trapping this quantity of high-quality liquid assets is serving no useful purpose and is actually having some significant costs. The discount window is not the only source of access from the central bank. Recently, the Federal Reserve has put in place a standing repo facility, which is another source of liquidity that could be very useful. So far, not that many banks have signed up. My guess is they haven't signed up because they're not allowed to count it towards meeting their liquidity coverage requirements. So I'm going to pass the baton now to Randy, and maybe he'll pick up on this. I'm not sure what he's going to discuss. Randy?
Super. Thank you. Thanks for having me here. Thanks, Darrell. I will pick up on some of Darrell's remarks about liquidity because I do think that that's where we should be focused. I think that's the true lesson of SVB and the most useful policy work going forward. Let me join with Darrell also in congratulating John on the 30th anniversary of the Taylor Rule. I am not a monetary economist, although I play one on TV, but I did spend 4 years in the Bush 43 administration as John's right-hand man at the Treasury, where I learned everything I know. He might not want to claim that at the moment, certainly about bank supervision, but everything I know about government policy and government action. So let's begin at the beginning with SVB. What happened? What are we doing about it? What should we be doing about it? What happened? Lost in the unseemly orgy of recrimination and political maneuvering is a very simple story that we've seen before. Well-meant, but ill-judged and highly stimulative fiscal policy engenders a serious and stubborn inflation, which is the prime cause for a category of financial institutions that have particularly interest-sensitive assets and particularly mobile liabilities to come under great liquidity pressure that's exacerbated when the Fed takes sensible steps to bring that inflation under control. That's the fundamental story of the savings and loan crisis of the 1980s, although that story played out over decades. And in our much faster, although not obviously better world, it's playing out now over the course of a year or so. So as we think about lessons learned, I think we have to keep that firmly in mind. One, when we come across a building in flames, we may have issues around the margin with the firefighters, but our first instinct should be to blame the arsonist, not the firefighter. And the second thing to keep in mind is that this is actually not over. Interest rates will stay higher than many are currently expecting them to stay for longer. And the consequence of that will be that this pressure will remain on this category of institutions and a broader category of institutions than we are currently expecting. So the question is, what should we be doing is not a purely prospective one for what should we do over the next several years. It is a question of what should we be doing right now because it's not over. So to begin, what are we doing? Well, if we take we in this circumstance to mean the current management in charge of the policy apparatus of the US government, the roadmap appears to have been laid out in the Barr report. The roadmap laid out by the Barr report has 4 key takeaways. SVB's managers failed to manage their risk. I'm not sure that required 102 pages. Yes, okay. Supervisors did not appreciate the extent of the vulnerabilities. Ditto. When they did recognize vulnerabilities, they didn't do enough about it. Check. And number 4, which appears to be doing a lot of the work in the report, the board's regulatory tailoring and a shift in supervisory culture impeded effective supervision by reducing standards and promoting a less assertive approach, all apparently at my behest. So most of the roadmap seems to derive from this last conclusion. And it is not just loopy, but obviously loopy. So first, let's look at the tailoring of regulations and start with capital. The principal relevant capital change allowed SVB to exclude losses on available for sale securities from regulatory capital. Now, there's a reason for that. It was not just driven by a surfeit of warm feeling towards the kindly bankers. It was applicable to a large category of banks even before the tailoring effort. And it's to reduce the incentive to push large amounts of securities from the available for sale account into the hold to maturity account, where generally accepted accounting rules do not change the accounting statements as a result of changes in the value of the hold to maturity portfolio. And since losses in the hold to maturity portfolio were the key trigger for the SVB run, it was probably wise not to increase the incentive to increase the risk in that portfolio. But even setting that point aside, and more fundamentally, even under the pre-tailoring capital rules and requiring SVB to hold capital against changes in that available for sale account, SVB would have exceeded its capital requirements by a very wide margin. It would have had 10% CET1 ratio versus a required 7%. The tailoring made no difference. Move to stress testing. Tailoring excluded SVB from the capital stress test, but SVB would have done fine under the Fed CCAR test. Those tests contemplate a severe recession. They contemplate interest rates falling. There's no evaluation of funding stability. We did run one stress test during my time at the Fed, one stress test over the last decade in which interest rates rose in the stress scenario. SVB would have been fine because most of its securities were in that hold to maturity portfolio, which would not have been affected by the rise in interest rates. SVB had few loans, so there would have been few credit quality problems. It would have been fine. Excluding it from the stress test made no difference. Move to liquidity. Tailoring excluded SVB from both the net stable funding ratio and the liquidity coverage ratio. But SVB would have passed the net stable funding ratio easily. It would have needed about $8 billion more high-quality liquid assets to pass the LCR, but it was awash in liquid assets simply by investing a little more in longer-term treasuries and a little less in Freddies and Fannies. It would have easily passed the LCR as well, even assuming the LCR applied to it, the full LCR, and it wouldn't have applied to it. It would have applied to it only because it had $14 billion in cross-border assets, and the threshold was 10. that's obviously a threshold that they simply would not have crossed. There was nothing that was critical about that $14 billion in cross-border assets to SVB's business plan or its operations, and they simply would have stayed under $10 billion, and then they would have easily passed the LCR without even that small tweak in the composition of the portfolio. So this is supposed to be the latest technology, but so even the Barr report acknowledges that the pre-tailoring regulations might not have prevented SVB's failure, which is Fed speak for would not have prevented SVB's failure. And I could be better company if I could remember whether it was William James or Mr. Spock from Star Trek who said, "A difference that makes no difference is no difference." So that, in fact, was the entire thesis around the tailoring changes that we made at the Fed in 2019. That we could significantly reduce the cost of regulation on a category of institutions, thus improving the ability of the system to provide credit to the real economy without materially changing their likelihood of surviving stress. That is, in fact, the Fed's own conclusion after analyzing the effect of the tailoring changes on Silicon Valley Bank. It is perfectly possible to have a coherent and well-reasoned belief that those tailoring changes should have been calibrated differently, or not done at all. I think you'd have the worst of the argument, but that's a reasonable position. SVB, however, is not evidence for your case. It's not evidence that you would be right. It is, so far as it is evidence of anything, evidence that you were wrong. Which brings us to supervision, and the claim that a shift in supervisory culture impeded supervision and created a less assertive examiner force. During my term at the Fed, I would occasionally receive emails that would slip through the Fed's various attention filters from a woman in a mental hospital in Marseille, sometimes in English, often in French, who had a number of grievances with the operation of the universe, although most of them centered on perceived injustices visited upon her by her sister, who had her committed to that hospital many years ago. Her long notes had the calm and quiet lucidity of the mad, carefully enumerating a range of plausible data points in support of obviously preposterous conclusions. And the address line of these emails, when they would make it through the filter, I could see that she would address these missives to 5 people: the Pope, Hillary Clinton, Bill Gates, Janet Yellen, and me. And these looked like real email addresses. And he sort of looked at me and he said, "No, that's not something that you just sort of make up. It's like somehow, crazy people have a lot of time on their hands and are quite resourceful." I think she had their email addresses. She certainly had mine. And I have to say that even though the substance of these emails was completely mad, carefully detailing the various ways that public statements from Bill Gates and from me showed that we were in league with her sister to keep her imprisoned, and pleading for respect and help from His Holiness, I knew that they were written by a woman who had been committed for life to an institution for the hopelessly insane in the south of France. I was kind of flattered. I felt much the same way reading the Barr report. First, my message to the supervisors was not that they were to be less assertive, but that they were to be more focused on the things that really mattered and more assertive on those things. The phrase I would often use is that if they won't do what really matters, smite them hip and thigh. This is almost exactly the same message as Andrea Enria, my counterpart at the ECB, had in a speech in Frankfurt at the end of March, responding to concerns about SVB's supervision in the United States. Second, if somehow the supervisors thought I was saying to be less assertive, they obviously didn't listen, because there were over 30 matters requiring attention and matters requiring immediate attention at the end of 2022, and the great bulk of them were about routine administrative matters like third-party vendor management and audit management, very little on the core financial issues facing the bank, and no suggestion that there was any prioritization among them. It is important that we get this right. That was exactly the problem that I was trying to get the supervisors to address. Strip away the administrative dross, focus on the core issues, be transparent, consistent, and act with due process. The reason that it's important that we get this right is that bank supervision can't develop a way of being effective while also being transparent, consistent, and sensitive to due process. It will not survive a coming conflict with the modern judiciary. It will be found to be a farrago of impermissible delegation of congressional action and unauthorized resolution of major questions. So, if it wasn't tailoring and it wasn't weak supervision, then what was it? The core fact here is that the uninsured depositors at SVB, as Darrell has walked us through, behaved much differently than decades of experience would have led us to believe they would. And as a consequence, both the regulatory framework and bank management's expectations and supervisors' expertise were calibrated to expect that those deposits would behave as they had always behaved and not as they in fact behave. That's my hypothesis for why both good bank managements and smart, experienced supervisors would not have set their hair on fire over the potential risks at SVB. They looked at the bank and said, there are these problems developing, but thank God this bank is not funded by short-term wholesale funding or by deposits from other financial institutions or by brokered deposits, but by deposits from its core business customers. Those people do not run because they read something at lunch on Twitter, except they did. On March 9th, SVB experienced a deposit outflow of more than $40 billion. More than $100 billion was expected to leave the next day. Consider that in comparison to past bank failures. Before SVB, the largest bank failure in US history was the failure of Washington Mutual. It experienced 2 periods of large deposit outflows. The first lasted 23 days, and in that 23 days, $9.1 billion left the bank. In the second, $18.7 billion left over 16 days. In other bank failures resulting from deposit runs, deposits flowed out significantly more slowly than that. What happened at Silicon Valley Bank was a sea change, and the question is why? Was it because they were depositors of a particular type, or because they were depositors in a particular time? By the first, I mean, as we all know, the business model of SVB was to be concentrated among venture capitalists, their startups, and interconnected communities subject to fads, enthusiasms, and herd behavior. They look at Twitter on their lunch break, they see that Peter Thiel has said head for the hills, so they all do. But the second is, if it was because they were depositors in a particular time, by that I mean the 21st century, and it's not that these particular depositors saw what Peter Thiel had said, it's that we all saw what Peter Thiel had said on our lunch break when we looked at Twitter, and all of us could go to the computer and press F4 and move our deposits. And if the latter is the reason for the unusual behavior of these depositors, then that requires rethinking how we handle liquidity at the Fed. For decades, the Fed has been affirmatively eroding its core reason for being, which is providing liquidity to the banking system. The express mantra has been banks need to self-insure their liquidity. But we had a system where banks self-insured their liquidity during the 19th and early 20th centuries, and we saw that it was a wildly unstable system, in large part because banks had to self-insure their own liquidity. It simply isn't possible for a bank to self-insure liquidity in a world where all of its liabilities are going to be extremely runnable. It's why the Fed is not called the Bank of the United States or the Federal Central Bank. It is the Federal Reserve, because the core purpose for its creation was to create a central reserve from which liquidity could be supplied. Yet we affirmatively prohibit banks from taking access to Fed liquidity into account in determining their liquidity resilience. Why didn't SVB have any collateral at the discount window on the night before its failure? Because they had no incentive to do so. Indeed, the Fed affirmatively disincentivized them to set collateral aside at the window because they couldn't count the window toward their liquidity requirements. That is the main lesson of SVB. Not a more restrictive capital regime, or a more self-insured liquidity regime, or a more unfocused and assertive supervisory regime, but a rethinking of the misguided undermining of the Fed's core liquidity mission that we have been engaging in for decades. Thank you.
Thanks, John, for the opportunity, and I'll start by congratulating you again on the 30th anniversary of Taylor Rule. I think I'll probably be disagreeing from here on with the rest of the panelists, and that's why I think the panel was formed, I guess. So what I thought I'll do is give you a sense of what the actual data looks like. We have lots of anecdotes. And what do I see as the problem, and what do I see as the short-term diagnosis and solution and the long-term solution to this problem. There'll be a lot of common themes with what Darrell and Randy have said, but the way I think about these things is a bit different. So here it goes. So when the whole turbulence started, the rhetoric out there was that SVB is an outlier because, yeah, these things rarely happen. And we were curious, we as in me and my collaborators, because we were looking at uninsured leverage for some time, actually. And it's true that a lot of connections and so on have formed in the recent times, but uninsured leverage is interesting because uninsured depositors or uninsured debt runs faster than insured debt. And if that happens, that could always lead to instability and fragility, and that's why we were interested in doing it. But when Silicon Valley Bank happened over the weekend, we just had nothing else to do, so we decided to basically stress test the whole system to see what was going on. So just to give you a sense, we talk about Silicon Valley Bank, but here is the entire US banking system. So $24 trillion of assets, $24 trillion of liabilities, and assets are in securities, in loans, and so on. But what's interesting for you to see is that when you look at liabilities, there's $9 trillion of insured deposits, and there's $9 trillion of uninsured deposits. Darrell quoted the number as 7 trillion. That's as of today, because as you can imagine, some of the deposits might have gone somewhere else. There is also equity, which is a very important number in the aggregate. That's about 2 trillion. So that's the capital that we talk about. Now, why is this important? Because what we did was just took the assets of the banking system and marked to market these assets because we had nothing else to do. So what do you find? You find that the banking system has $2 trillion of losses when you do mark to market analysis. All of this is not in loans. Some of this is in securities. What kind of securities? We are talking about treasuries. We are talking about the most liquid RMBS. So this is not the traditional, hey, there are these loans, long-term loans, they are tied up. Banks are doing something special. These are quintessential liquid securities, safe securities, but we have $2 trillion of mark-to-market losses. Why is this important again? Because remember, the aggregate equity in the system is 2 trillion. So when you look at the entire distribution in the economy, this is how it looks for 4,800 banks in the system. Lots of losses. The average here is around 10%, 2 trillion on 24 roughly. If you look at that vertical line though, that's basically what SVB is. Why is that interesting? Because if you thought that SVB was an outlier and special just because it got some losses, there'd be 500 other banks which should have faced a similar kind of run on that same day. But they didn't. And we know why, because initially people thought that maybe these losses are not there because there's a lot of hedging going on and we don't need to worry. These are unrealized, but hedging will take care of it. If you look at inside the banks and ask how much hedging is going on, the answer is not too much. One simple way to look at how much hedging there is going on is to look at duration of assets that the bank has where the investments have happened. And there are two pictures here. One is orange, which is before monetary tightening, and the black is during the monetary tightening. And what you see is on average, you're talking about 4 or 5 years after hedging, whatever hedging the bank is doing, which tells you there is not a lot of hedging going on. There are a lot of unhedged assets that banks have. So those losses, even though they are unrealized and marked to market over the monetary tightening, still are with the banks. So why did we see a lot of runs in the case of SVB and other banks? And the answer right now is very clear. It had to do with uninsured leverage. So this is how the uninsured leverage in the system looks like across banks. The vertical line again here is SVB. And if you sort of look at SVB now you can see why this happened to have a bigger bite for SVB. There's about 1% of banks who are more in terms of uninsured leverage, but there is other banks in the system as well. Now, how do we think about uninsured leverage, right? Is it just that VCs are talking to each other and that just is going to trigger the stuff, so let's get VCs out of the Twitter and social media and everything will be fine? That's where kind of economics comes in, that, uninsured leverage is runnable. They run first. They are going to run if there is enough of them thinking that there are others who are going to run. And that's just the traditional ways in which we have thought about coordination problems and so on. And so how do we want to sort of take this and figure out how much risk is in the system? Well, one thing we can do is what Darrell did, which is to say, hey, let's take 100% of uninsured depositors and assume that if you have losses, they might get spooked. And if they run, what happens? That can give you some sense of what the potentially insolvent banks in the system might be, provided that the asset losses are completely wiping out the equity. And that's the kind of exercise we did. So we took uninsured leverage and unrealized losses under the assumption that all the uninsured depositors are going to be running if they are spooked. So the economist called it, you're looking at flight risk versus turbulence, which is exactly the right way to think about it. And here is how the picture looks. So this is the distribution of banks in the system which would be insolvent, which is equity would be underwater, in the US. And on the y-axis is losses, which I showed you. And on the x-axis is how much runnable uninsured leverage they have. The size of the bubbles tells you how big the bank is. So the biggest bank out there has more than $1 trillion of assets. So you can imagine which one that is. There is SVB there, but that's not an outlier. There's a bunch of others of similar sizes floating around in the system. So how should we then think about this? Because this is a pretty extreme scenario where we are assuming that all the uninsured depositors run. And this is basically the whole distribution of all the banks in the system. Again, there are two pictures here. Orange is before the tightening, black is after the tightening. And what you see here, that if you look at the capital in the system, the banking system was well capitalized before the monetary tightening, which is what the orange curve usually is, what people argue about. And then after the tightening, assuming that all the uninsured depositors run, you would see that you have a bunch of banks below zero. What that means is equity is underwater. So when I say a lot of banks are insolvent, I showed you those dots before. This is the distribution. So a bunch of banks could be potentially insolvent. Is this the right way to think about it? Kind of, because it depends on what kind of run do we have in mind. This is not the classic Diamond-Dybvig model applied just because it won a Nobel Prize. Doesn't mean it's applicable immediately to what we are seeing. Those runs are liquidity runs. They are not solvency-based runs. A solvency run is different. And the reason why I kind of disagree a little bit with Darrell and Randy is that it's going to be something that happens in this scenario when the interest rate rises sufficiently. That's the first condition that has to be true. I'm not sure that in the last 15, 20 years when those things were being plotted, we even faced this risk because this condition was just not satisfied. The interest rates have to be large enough for this to happen. And then what does have to happen is enough uninsured depositors have to think that other uninsured depositors are going to run because of these losses that you are seeing. And again, these losses are just purely based on liquid assets where the value of the assets have gone down. And if there is enough uninsured depositors who think that other uninsured depositors are going to run, you could end up in a bad equilibrium, bad, quote unquote, where you will see a run happening like we saw. Because essentially what ends up happening is the bank then has to hit the market and take those securities and loans and sell them to satisfy these uninsured depositors, and you get a classic run. Those unrealized losses become realized. When does this happen? If it does happen, well, it happens if you have lower initial capitalization. So if you have low equity, that's the first reason why you will see this run. So that's the fundamental thing, that you've got to have enough equity in the system. But leaving that aside, what will also be true is that if you have a higher proportion of uninsured depositors because they run first, or more awake depositors, maybe because of VC and social media, you're going to see more such risk in the system. So if you took this seriously and asked, hey, then what is really the risk? Well, what we really need to do is to figure out what that sunspot bad equilibrium is going to look like, and that's going to be a function of how many uninsured depositors are going to think other uninsured depositors are going to be running. So that's what these two pictures plot for you. There are different scenarios with uninsured depositors running from 0 to 100%, and then on the left is number of insolvent banks, equity underwater, and on the right is assets in trillions of dollars at risk. And what I want to sort of show you is the two red numbers. So if we assume half the uninsured depositors run, we have about 200 banks at risk and $300 billion at risk. This is after SVB and others have been taken care of. But of course, if we take a more extreme scenario and the equilibrium is different, you get higher numbers. So what about regulators in all this? Well, regulators, as has been mentioned, have kind of diagnosed this problem as a liquidity problem. The Fed report, the Barr report had mentioned liquidity 320 times, and solvency was mentioned once, which is, I think, was a typo. But you know, this is not the usual liquidity issue, because there is lots of liquid assets. We are talking about 30% roughly liquid assets on the asset side, and there have been a lot of liquid interventions. Yes, there is bad management and board of directors who are always the usual scapegoats, but I actually think there is something else going on which has not been talked about, which is the political economy of enforcement. It's a pretty complex system. If you look at all the mid-sized banks, and actually not even mid-sized, pretty large banks now, like Silicon Valley Bank and First Republic, they are regulated by multiple regulators. Why is multiple regulation and regulators interesting? Because political economy comes in when you have state and federal regulators. In a study long ago, 10 years ago, we pointed out that there is a huge amount of inconsistency. What does that mean? So because federal and state regulators regulate a given bank in rotation, what ends up happening is they are never implementing the same rule the same way. And what exactly happens? Well, the state regulators tend to be too soft on the bank. Why? Because it's too big to fail in their local economy. So here is a picture. The white is states looking at a bank, and the gray is federal regulators looking at the same bank in rotation. This is your Silicon Valley Bank or First Republic. And what's plotted is Camel's rating, which is everything a bank lives and dies for. So a good rating means a smaller number. Higher rating means pretty bad and bad stuff happening. And what does this tell you? Whenever Fed comes in gray, they raise the Camel's rating, and whenever the states come in, they take it the other way. Why? Because, you know, Silicon Valley Bank is pretty important to me. So enforcement and political economy is not something that we can avoid. And that gets me to the last couple of things that I want to mention, which is beyond SVB. So we've already seen this is not an outlier. Hopefully I've tried to convince you it's beyond just these three. The question is this really a tech phenomena? And is this something that is only happening in the California state? You know, we see hearing about all the banks here. And the answer is not really. If you took that picture that I showed you before about insolvent banks and asked what deposits in the US across regions are at risk, this is how the map looks. It's not important how the map is. I just wanted to convey to you it's not just Silicon Valley, and it's not just East Coast with Signature Bank. I mean, the market has not been blind to all this. You can see how the market reaction has been to the regional banks, and it's pretty depressed. And it's telling you loud and clear that there is a bunch of banks in the system which are insolvent, and you know, we can try giving them more liquidity like we did with First Republic, but the fact of the matter is it's insolvent. So what next? We have extended the coverage to uninsured deposits, maybe $7 trillion. We have a bank term funding program which buys at par even though the assets are underwater. And that's going to be good for short-term risk. But because there is a bunch of potentially insolvent banks, you always worry about the saving and loans crisis. Why? Because we had gambling for resurrection there. When we had a bunch of banks underwater and were protected on the liability side and were allowed to take risks on the asset side, they did take a lot of risks. And we ended up with a huge amount of losses in the second stage of saving and loans crisis, which hopefully many people remember. So what's the answer? So I think in the short run, you know, the answer is you've got to figure out what's the best market test to separate out insolvent from solvent banks. The idea that we are going to just keep pumping in money, taxpayer money, to save the entire banking system seems ridiculous. And as a result, a few of my colleagues in the audience and other collaborators, we wrote a proposal following the analysis that we had done. And the idea here is that the banks should promptly raise equity capital, which will both reduce fragility and provide the needed market test to identify truly insolvent banks. This is something that Anat wrote a long time ago in a proposal as well. That's in the short run. If we can't raise equity right now because of various reasons, at least the regulators need to come out and do a stress test so that the market can have a sense of which one is insolvent, which one is not insolvent. And what about the long run? And this is where I sort of kind of disagree a little bit with Darrell and Randy. If I look at what the rhetoric is that is coming out from regulators, here are the kind of things that are being said. We need careful regulations to address unanticipated and unprecedented risks. The last time I checked, interest rate risk is in the first chapter of any finance MBA textbook. And if 4 collaborators working on 2 days over a weekend can do the stress testing the way we did, I'm not sure it was that unprecedented and unanticipated. So I think the ultimate answer is, rather than trying to tweak this into an amazing physics laboratory-based experiment, we got to just realize there are limits to regulation and what regulators can do. And I think the answer is right in front of our eyes in some of the experiments we have done. Here is an example from a $10 trillion mortgage market in the US, among all the mess that we have around regulation. And what have I plotted for you is how much lending they are doing. That's the x-axis. And the y-axis, how much equity, back-to-equity capital they have. And the orange line is banks. Remember, banks have a huge amount of government-backed insured liability structure. And the dark black line is shadow banks or non-banks, which are completely uninsured. Remember, they have complete uninsured leverage. When you give someone complete uninsured leverage, what do? Well, they end up taking a lot of equity. Why? Because they understand there's a lot of risk. And when they have a lot of risk, they are able to provide the same amount of services that banks are providing. So I think in the long run, the answer is not liquidity. The answer is significant amount of equity capital, and that's where I ended.
Okay, fortunately, I don't have to say as much because Amit said some of what I would say. It's not a liquidity problem. And I would also add that I agree that because we have central banks, we don't necessarily need self-funded liquidity, but we do need self-funded solvency. And that's what it's about, really. Credit Suisse also had runs. It wasn't about interest rate risk. It was about insolvency, though. Same thing. Credit Suisse has been on the edge for 3 years, managed to have bad business, bad management, and just not a viable business model, and it finally caught up with them. And so they certainly were non-viable. That's why they needed all these supports to make this transaction happen. We did not hear anything about too big to fail and about TLACs from those on the panel that had that. So I can take the liberty of asking, especially Randy, what he thinks about Credit Suisse.
Credit Suisse has kind of been taken, has triggered a lot of discussions about resolution structures and resolution planning, and basically the theme being, so was all of that a complete waste, right? It was very hard, it was reasonably burdensome, and seems to have been completely ignored. I think, I'm talking with a number of the regulators who were involved in the, in the Credit Suisse UBS merger. I take it as an example of what I at least always expected would be the end result of the resolution structuring and resolution planning effort, which would be to prove Dwight Eisenhower's maxim as he prepared for D-Day, that plans were useless, but planning was essential. And that was the theme that at least I've heard from a number of the folks who were involved in that process, which was we had a lot of plans as to how Credit Suisse could be resolved. And that was, in fact, very useful when it came time to figure out exactly what we were going to do. But it should never have been expected that we were going to take one of those plans off the shelf and implement it, whether it was Bailey and the TLAC or exactly as expected. It was this demonstrated, we had worked out, we had thought through a number of the dynamics in different situations, and it was very helpful to have done that. So, I probably would have resolved it in a different way, but I don't think it demonstrates that if you're going to have something like Credit Suisse UBS, that's an indication that the official sector has thrown all of that work in the trash. It's exactly what we should have expected to be the result of that.
Okay, I'm going to just connect the two cases here by just asking the following. Because Amit was talking about equity and I talk about equity, what is it that makes TLACs better than equity for the purpose of absorbing losses? When you need to trigger it, when you need to go into resolution, what is it that, this is a kind of question I've been asking for about 15 years and never got an answer to, so I'm trying again. From a social perspective.
Yeah, well, if you're directing that to me, I've never been the world's biggest fan of TLAC, so maybe you should direct that to someone else on the panel. Okay. Darrell, do you?
I'm with Randy, equity, all the way.
Oh, okay, good, all right.
I want to repeat what I said in one of my opening remarks. This crisis that we're facing was not a liquidity crisis. It was a solvency crisis.
But then your balance sheet didn't have equity and you only talked about liquidity. So trapped capital, which trapped liquidity. Capital is not trapped. Capital is about the funding mix. If you have loss absorption, then you can take risk. That's how Silicon Valley operates in general, not the Silicon Valley Bank, Silicon Valley. A lot of equity. And then they fail, no problem. Okay, so I think Mike Boskin wants to ask a question here.
Two questions. I'll make an observation because it was mentioned. You mentioned about the political economy, the regulation, and the knowledge of the regulators. Back when we were cleaning up the S&Ls, I asked the 4 bank regulatory agencies what the experience level, the distribution of the experience level of the examiners, and a very large fraction had never been through a deep recession. Now, nobody under 60 has been through a big increase in inflation in their working life. So that's a wrinkle on this that's probably has something to do with delay and inertia and et cetera. The second point I wanted to make was back then, banks were extending 70-75% of credit, and non-banks were, the credit markets were maybe a quarter or a little more. Now that's flipped. And so my first question is, how does that affect your thinking, not just about prudent regulation of an individual bank, but prudent regulation of the system embedded in this larger credit system? And third is, if we're thinking about capital for the overall banking system rather than for each individual bank and its potential, Apple's basically becoming a bank. And back when we were trying to change things, we were trying to get the Fed to go along with letting Walmart become a bank, for example, to get more heavily capitalized institutions into banking. And they resisted that. And by the way, we also tried to push the idea of unifying the regulators, something outside the Fed. And the Fed deeply resisted us, getting back to the last panel, because they said we needed the information from our regulation and supervision to conduct monetary policy. So just a couple of observations, 2 questions about how does the big shift in where credit's coming from in the economy, and about other sources of capital rather than the current individual banks raising capital.
Anybody wants to take, let's take another one from Mark Bordeaux.
Yeah, this is for Darrell Duffie. I mean, there's an anecdote from history that might be relevant. So there was a paper, I think it was like 60 years ago, by Philip Kagan at a conference, which was a retrospective on the national banking system. And so one of his points that he made about why the national banking system didn't work is they imposed these really large reserve requirements on all the different categories of banks because they thought that the problems of the free banking era was one of they were not reserve requirements. But actually what happened is there were just as many, in fact, worse panics in the national banking system. And one of the issues was that the banks felt that they couldn't touch these reserve requirements. Okay, so it just feeds right into your comment.
One more behind him, and then we'll answer.
I'm Bill Nelson from BPI. So in the mid-1950s, during one of the Fed swings away from the discount window, when they were trying to actively encourage institutions not to use the discount window, they created and used a combined capital and liquidity metric, in which basically assets were lined up by liquidity and the liabilities were lined up by runnability, and your capital was evaluated as some measure at sort of fire sale prices to the extent that it was needed. I don't know if that's exactly the right approach needed now, but I'm wondering if you all see as attractive some kind of combined liquidity capital test.
Okay, let's go quickly here, and then there are a few other questions I want to get to. Maybe Jeff, like over here. Oops.
Let me take the bank, non-bank one. So just very quickly, obviously that is a huge factor in many of the recent stresses, certainly during both COVID and the great financial crisis. The Fed has had to develop a number of ad hoc facilities, ad hoc mechanisms to provide liquidity to the whole financial system outside of the banking system, given how large the non-bank sector is. Clearly, if you were designing the Federal Reserve today, instead of in 1913, it would not occur to you to say that its authorities and focus should be on the banking system. It would be the central flywheel of an integrated financial system. And we should regularize that. We should acknowledge that the non-banks are an important, integral, totally appropriate feature of the financial system. The Federal Reserve has a totally appropriate, particularly liquidity provision mandate for the financial system, and connected with that, it should have a totally appropriate regulatory and supervisory mandate over the non-bank system as well. And we should just, and we should absolutely rationalize that, because we are effectively trying to impose it in each period of stress on the fly, ad hoc, with limited, clear authority, and having really not thought through the full implications of trying to do that at an integrated level, and we should do it.
Oh, well, first, very briefly, Mike, I do think there's an issue about whether the central bank should also be the banking supervisor. Michael Bordeaux and I are Canadians. In Canada, the Bank of Canada does not regulate banks. It's the Office of the Superintendent of Financial Institutions. The United Kingdom has gone back and forth on this issue. It's definitely up for grabs. When Axel Weber, the head of the Bundesbank, was asked, what about doing bank supervision? He said, no, we don't want to do that because we don't want that conflict of interest, and we want to focus on monetary policy. For the United States, I think it deserves a lot of study before you just go ahead and propose a separation, but it should be up in the air. Michael, on your question about the national banking era, absolutely right on. I referred to Charles Goodhart's last taxi analogy. Gary Gorton's paper on the national banking era and the amount of trapped liquidity, he has brought that forward into modern liquidity regulations and said, this is not a good idea. I'm, as you know from my remarks, I'm all in favor of using a central bank for what it was intended to do, be a lender of last resort to provide financial stability, notwithstanding the very good points that Amit and Anat have made about...
What should it lend to insolvent banks?
About it starts with capital. The issues of liquidity are to address solvent banks. The Fed is not permitted legally to lend to banks that are insolvent. And on this last idea of combining liquidity and capital regulations that Bill Nelson raised, I definitely think that banks should be given an incentive to raise their capital by making a trade-off between liquidity and capital so that we end up with the situation that Amit described, where bank shareholder capital at risk does not end up in I think you called it a physics laboratory where we're trying to titrate all of these complicated liquidity regulations. Just make it simple. Give an incentive for banks to raise enough equity capital that these liquidity considerations drop into the background.
well, maybe cancel liquidity regulation altogether. Amit?
I'll just say one thing related to non-banks. Michael, I think your point is very relevant because non-banks are very big now. At the same time, we have 4,800 banks. And I think that there is a lot of political economy on how big non-banks have become in what parts of the country, in what segments, which is real. And I think part of the reason why otherwise activity is not moving to non-banks as it should, because banks have become a very clunky business. That's what I take from all what I hear.
Jim Bullard, St. Louis Fed. So two things. One is that this is based, this insolvency stuff is based too much, I think, on mark-to-market accounting. Sure, if you had that, you'd have a different system, but this was all set up to not do mark-to-market accounting. I think there was good reason for that. Interest rates can fluctuate for other reasons. You don't want that reevaluating the capital in all these institutions. Then you have crisis on your hands. So there's good reason to say that maybe it is set up wisely that you don't use mark-to-market accounting for this particular business. So I think I'd like to get a comment on that. And then on dividing everything up between insured deposits and uninsured deposits. I mean, what are we doing here? The uninsured deposits should be managed by somebody. There should be private insurance for that or other arrangements. If you talk to bankers, there does appear to be other arrangements behind those so-called uninsured deposits, so they aren't as runnable as they appear. That's why SVB probably was a quirky institution. And these other banks that have deposits that look like they're uninsured are really not in that situation. So I think it's more subtle than it's being portrayed by the panel here.
Okay, we're a little bit over time. Maybe one other question and then final quick remarks.
Harold Julik from the University of Chicago. The inconsistency of regulation really, or the time inconsistency of regulation really concerns me here, right? We thought there could be uninsured deposits, and then we learned they're all insured. We thought we should only lend to illiquid but solvent institution, right? That's the old principle, and the Fed is still supposed to do this. Now we're bailing out the insolvent banks. We're supposed to do something only about systemically relevant banks that are systemically important, and suddenly we declare a small, tiny bank like the SVB to be systemically important. So it seems to me that there's always a taxpayer put at the end, and when we design regulation, we have to think really, really hard about what would regulators do at the end when the house is on fire and they promise not to do something beforehand.
Okay, final comment. I would just say to Amit, by the way, that the inconsistent regulator, this were all federal regulators that gave high ratings to these banks, all federal. So that makes you pause.
So I will take up Jim's challenge that I do think that there should be recognized to be a difference in the situation for an institution that has assets that will in fact cover its liabilities if they can be held to maturity, which is why they put them in the held to maturity account, and that in thinking about the provision of liquidity, the central bank should consider that institution differently than an institution that has a huge credit loss in its loan portfolio that is, that's much more difficult to resolve itself. So I think exactly how you think about that. The Fed did try to, obviously tried to address that in the BTFP in the terms of the BTFP proposal by lending against them at par, then at a discount. That is irregular in the Fed's religion and sort of traditional practices, but I think is reasonable to think about how to regularize and institutionalize that.
By the way, when interest rates go up, depositors also want higher interest rates. So the assumption that the debt is going to stay where it is when it is a short-term debt is also questionable, I would say.
Darrell, do you want to say something? Or I have a couple of things to say.
Just on the mark-to-market accounting, it's very difficult to do, but we do have stress tests that can emulate the effect of mark-to-market accounting for purposes of ensuring adequate capital. And agreeing with Amit, it's kind of weird that an interest rate shift of 400 to 500 basis points, it should not have occurred to the Fed, which is itself was implementing that interest rate shift, that it had implications. Whether you mark the assets to market or not, a stress test for that shift in rates was kind of an obvious thing to do before the Fed got well into the interest rate raise.
Yeah, so just
Okay,
one last thing,
yeah.
which is related to, again, the comment that Jim made, because I have no inconsistency with what Harold was saying. When the accountants pushed for hold-to-maturity accounting for banks the way they did, there was a discussion about looking at structure of liabilities and whether the banks are solvent, because this whole idea that you have hold-to-maturity makes sense when the banks are illiquid but solvent. And they don't have runnable depositors like so many uninsured depositors. So there has to be a triangulation of the two. We did the hold to maturity, but we completely forgot about the other two things. And that needs to be fixed, in my view, going forward.
Well, we are past time, so thank you all very much for attending.